As of the market close on Friday, November 21, 2025, Nuburu Inc., trading under the ticker BURU on the NYSE American Exchange, sits at exactly $0.2041 per share. The stock experienced a significant upward push during the final trading session, closing up roughly 8.33% on the day. If you are looking at your screen right now expecting live movement, remember that the markets are currently closed for the weekend, and this 20-cent 41 figure represents the final confirmed price until the opening bell rings on Monday morning. That 8% intraday move is not just a random fluctuation, it represents a sudden injection of speculative volume that demands serious attention, especially considering the company's history of extreme volatility. When most retail traders scan a chart like Nuburu's, they see a penny stock trading near 20 cents that has suffered from capital degradation, delisting fears, and a complex history of reverse splits. The immediate expectation is that this is a dead money trade, a company limping along on the path to zero, likely to be ignored by serious wealth managers at Fidelity or Schwab Intelligent Portfolios. The expectation is that industrial laser manufacturing is a slow-moving, capital-intensive sector that cannot possibly generate the kind of explosive returns that tech investors chase in NVIDIA stock or Tesla stock. However, the reality emerging from Nuburu's corporate headquarters in Centennial, Colorado, creates a friction against that bearish expectation. We are not just looking at a manufacturing tool company anymore. As of this month, November 2025, we are looking at a company aggressively forcing its way into the high-stakes global defense sector with NATO-compliant drone technology. The reality is that the market is pricing this as a distressed manufacturer, while the company is restructuring itself into a defense technology asset. This disconnect between the penny stock price tag and the defense contractor ambition is where the opportunity and the massive risk lives. Let's examine the trading action we witnessed this past Friday. The surge to $0.2041 was driven by a specific catalyst that changes the thesis for anyone holding this in a Robinhood account or an Interactive Brokers speculative portfolio. The company announced a framework for a joint venture with Maddox Defense to develop military drones. This is not a vague promise. They are targeting specific NATO-compliant unmanned aerial vehicles, UAVs. In the world of microcap stocks, news is often noise, but this specific partnership signals a pivot that the algorithm-driven trading desks at major firms are trying to price in. The volume spike we saw on Friday suggests that some aggressive capital is betting on this pivot being genuine. When a stock trading at 20 cents announces a venture targeting the massive global defense budget, the resulting volatility can be violent. For traders using SoFi Invest or similar agile platforms, this creates a scenario where the technical ceilings, the resistance levels, can be shattered very quickly if the news cycle continues to favor defense spending. To understand why this move matters, we have to strip away the stock price and look at the fundamental technology. Nuburu is known for blue laser technology. This is a distinct departure from the infrared lasers that have dominated the industrial landscape for decades. If you look at how companies manufacture electric vehicle batteries, a critical component for Tesla stock and the broader EV sector, they often struggle with welding copper. Copper is highly reflective to infrared light. You blast it with an infrared laser, and a huge portion of that energy just bounces off. This is inefficient and leads to defects. Blue light, however, is absorbed by copper much more effectively, nearly 10 times better than infrared. This physical property allows Nuburu's lasers to weld copper with speed and defect-free precision that legacy lasers cannot match. This is the old bullish thesis, that Nuburu becomes the standard for EV battery manufacturing and consumer electronics, perhaps even influencing how Apple stock supply chains manage component welding. But the new thesis, the one driving the price action this November, is about applying this power density to defense. The announcement regarding the Maddox Defense Joint Venture is critical. The stated goal is to manufacture adaptable military drones. Why does this matter? Because the modern battlefield has shifted entirely toward unmanned systems. By integrating their high-power blue laser capabilities into a defense platform, Nuburu is attempting to transition from a supplier to a systems provider. This distinction is massive for valuation. A supplier gets squeezed on margins. A systems provider gets government contracts. The market's reaction on Friday, lifting the stock over 8%, is a tentative vote of confidence that this transition might actually work. However, we must temper this excitement with a look at the liquidity and market structure. Trading a stock like BURU requires a different mindset than buying an ETF through Fidelity mutual funds or setting up a passive strategy in Schwab Intelligent portfolios. The liquidity here can dry up instantly. We saw millions of shares trade hands on Friday, but on a quiet day, the spread between the bid and the ask can widen significantly. This makes it dangerous for anyone using market orders. If you are trading this on a mobile platform like the Robinhood app, you need to be using limit orders. The price of 0.2041 is the midpoint, but the reality of getting in or out at that exact price depends heavily on the momentary depth of the order book. This is a stock where slippage, buying higher or selling lower than you intended, can eat up your potential profits if you are not careful. We also need to address the institutional landscape. You generally won't find this stock in conservative Fidelity IRAs or widely held SoFi ETFs. It is too small and too volatile for the strict risk parameters of most Fidelity wealth management advisors. This means the price action is largely driven by retail traders, day trading algorithms, and a few high-risk specialized funds. This lack of institutional ballast means that when the stock drops, it drops hard, as there are no large pension funds stepping in to buy the dip. Conversely, when it rips without a ceiling because there are no large institutions selling into the rally to rebalance their portfolios. This is pure, unadulterated supply and demand mechanics playing out in real time. Let's look closer at the Techni partnership mentioned in their recent November press releases. Nuburu executed the first tranche of a financial program with Techni S.p.A., an Italian company. This involved a €2 million transaction. This is part of a broader strategy to create a transatlantic defense platform. The complexity of these deals, involving inventory monetization and cross-border cooperation, is often too dense for the average retail investor to parse, which is why the stock price often lags behind the actual news. The market takes time to digest what inventory monetization actually means for the company's cash flow. Essentially, they are finding creative ways to unlock capital to survive. For a company that has burned cash rapidly in the past, these financial engineering maneuvers are lifelines. They allow the company to keep the lights on and the R&D running without necessarily diluting shareholders through a massive direct offering at these low prices, although dilution remains a constant risk in this tier of the market. The chart tells a story of a stock trying to find a bottom. Throughout 2025, BURU has faced immense downward pressure. The receipt of a warning letter from the NYSE regarding administrative timing of announcements, which we saw recently, added to the fear factor. Investors are terrified of a delisting. When a stock moves to the OTC, over-the-counter markets, many investing sites and trading platforms like Webull or Robinhood may restrict trading or margin, causing liquidity to plummet. The fact that Nuburu resolved this specific compliance issue quickly is a positive sign of management competence, but the threat of the sub-dollar share price remains. The NYSE generally requires stocks to maintain a minimum price. Trading at 0.2041 places them in the danger zone. This usually leads to one of two outcomes: a massive organic rally driven by fundamental news like a major defense contract, or a reverse stock split to artificially boost the share price. A reverse split is the ghost haunting every shareholder. If you hold 10,000 shares at 0.2041 and they do a 1-for-20 reverse split, you end up with 50 shares at $4. The value doesn't change mathematically, but psychologically, it often is a signal of weakness, and algorithms tend to short stocks heavily after a reverse split. This is the sword hanging over Nuburu's head. The current rally to 0.2041 is nice, but it is far from the $1 threshold needed for long-term safety. This creates a binary scenario. Either the Maddox and Techni deals start generating revenue immediately and force the stock up naturally, or the company will be forced to engineer its share structure again. Comment below how many shares of Nuburu you currently hold, or if you are waiting for them to regain the $1 mark before you consider an entry. I want to gauge the sentiment of the room regarding this